everyone, and thanks so much for joining us today. And thank you, Yassine, for hosting this conference call. So Yassine will present for around 20 minutes. And if you have any questions, please write in the chat, or after Yassine is finished presenting, then you can just unmute yourself. Anyway, over to you.
Thanks, Zara. Hi, everyone. This is the Q2 quarterly conference call with Greenbullinvest and eToro. So thank you, Zara, again for organizing it. It's an amazing initiative. I'm happy every one of you just joined. So I'm Yassine. I'm from the Greenbullinvest team. So first, I'm going to go through like an agenda of what we're going to talk about today. So it's going to be about the team background, who we are at Greenbull, who is the team behind Greenbullinvest. Then we're going to go through the investment strategy of our portfolio. We have 6 pillars that we want to talk about how we pick our investments and why we follow this strategy. Then we're going to have a quick portfolio performance review for the past 3 years to see like what was good, what was not so good, etc. Then we will go through a market outlook, so to see what 2022 has in mind for us. And then we'll have a Q&A sessions where you can write your questions and I'll try my best to answer them. So let's get started. So I think most of you are copying our portfolio as part of your experience with our company, which is the Greenbull Group. Our goal is to revolutionize the personal finances of individuals. So we are trying to offer the tools to people to invest better, to invest smarter. So we have top-tier investment technology, trading technology. We also have training courses for long-term investing and short-term investing. So I think maybe a lot of you come from our long-term investing course. And we also have a great social community on both Facebook and our own social app where traders and investors share ideas and tips on how to invest and what stock to pick, etc. Our company is based in France. We also have offices in Switzerland and in Dubai. So right now I'm talking to you from the Dubai office. It's getting pretty late, but I'm happy to be here. So about the Greenbullinvest team. So there is Guillaume, Yann, and myself. So Guillaume Monge is a high honor finance major. He's a fintech founder and also the president of the Greenbull Group, our company. We also have Yann Short, which is a licensed wealth manager, the co-founder of the Greenbull Group, and also one of the top 5 financial influencers in France, which they call finfluencers nowadays. Most of you probably know him as Yann Darwin on YouTube. And then there is me. I'm the communications manager at the Greenbull Group. I also manage the eToro page, but I'm also a trader and an investor. I have a long-term portfolio, and I trade on my short-term portfolio. I trade volatility and bonds. So let's go through the investment strategy. We have 6 major pillars that we follow in our portfolio strategy. So I will go through each one of them and kind of explain the logic behind them. So the first one will be mega caps. So mega cap stocks, large companies. So these are proven businesses. They're stable. They're kind of the go-to choices for most investors, most pension funds, and most retirement funds, etc. They pay a steady dividend every year. They have high liquidity, so since they're companies that are very popular, it's very easy to get in or get out of a position. You don't have liquidity issues that small companies have. In our portfolio, we chose to go a bit more tech than the S&P 500, so there is a bit more of a tech component. But one of the big pillars of our strategy are mega caps. We wanted to go with proven businesses, stable, get your dividends. They don't get shaken too much. And also the fact that they're preferred by investors and pension funds mean that there is a constant inflow of money every month from the savings or the investments of people working and putting money away every month. They go to these companies. So there is always kind of a support on the money side. So there is a buy side support that is always present with these companies. Our second pillars are, like everybody loves them, the major cryptos, so Bitcoin and other cryptos. We also have a couple of crypto companies like BNB and also innovation coins like Solana. So we all know Bitcoin and crypto is groundbreaking technology. We all know it's one of the best investment return in the past 10 years, but it's also very early. So I think it's a bit victim of its success. And so it's victim of the volatility and we don't really know where to put it legally. We don't know where it stands in the legal landscape, in the financial landscape. So there's still a bit of manipulations. There is a lot of projects that might fail. So it's still a bit early for crypto, but I think it's still good to be there early. We don't know really which project will succeed or not, but we thought it's important for a long-term portfolio like ours to have kind of exposure to innovation like crypto and not just go with the classical stocks that most indexes have. Then we have our third one, which is one of my personal favorites, which are the dividend aristocrats. So in this case, the goal is to get paid income whether the market is good or bad. So these are stocks paying high dividends usually, so bank stocks like BNP, ENG, etc., which pay upwards to 7% dividends. And the goal here is, of course, to have a constant income, cash income coming in, and not just to rely on high tech and innovation where they reinvest a lot of their earnings into the company and don't pay dividends yet to people. So here we want to really have some stability, a regular income generation, and more stable stocks that are both inflation hedges, but also they have tax advantages. Dividends are taxed differently than other fixed income like bonds or CDs, for example. Then, of course, one of the main pillars, we keep talking about it all the time in our courses, we talk about it in our conferences, is our long-term vision. So it's a 5-year plus portfolio timeline. The goal here is to invest in innovative companies that we really believe in for the future, and it's not a get-rich-quick portfolio. In the short term, we have to guess every time. What's the event? What does it mean? Is there going to be a war? Why? What's the monetary policy, etc.? In the long term, we know companies will grow. We all know that the companies in the US and France will be bigger in 10 years and more profitable than they are today. It's just a fact. We all know that real estate will be more valuable in 10 years than it is today. That's just a fact. So in investing, the time is on our side. So it's not about timing the market perfectly and getting at the bottom or at the top. It's by staying as long as possible in the market and get the better prices every time there is a liquidity crisis or a little bit of a panic. So it's a long-term strategy. There is very little point, to be honest, in checking the portfolio every day. The idea here is every month you do your DCA. We keep talking about it too in our courses, I'm sure you all heard about it. It's your dollar cost averaging. So in this case, every month you add a little bit at a good time. So let's say if there's a big red day where things are cheaper and there are companies you really believe in for the future, that's a good time to get in and add a little bit of money in your portfolio. So the goal here is to add a little bit every month and build long-term wealth, because we know that assets will be more valuable in the future than they are today. Then the fifth pillar, risk management. So we are diversified both on geography, so mostly in US and in France, because this is the main area of expertise we have. We have industry diversification, but we also have business model diversification. A lot of funds I see have the geographical diversification, they have the industry diversification, but they forget about the business model. So sometimes you have a lot of companies with a similar business model, but different industries and different geography, right? But then as soon as you have a very big innovation, you have a very big disruptor, then it shakes the whole portfolio down. So we try to make sure that we keep our diversification and our risk management also on the business model side, and not just the portfolio, the industry side and the geographical side. We have over 50 investments at the moment. We don't have any large weight investment like they might have in the S&P 500, where 30% is in tech. In our portfolio, we try to keep it kind of equal weight for most of the stocks we have, except for the high risk stocks and the cryptos, where they actually have a smaller allocation. We're just doing this so that the large movements we can see in these kind of innovative technologies don't mess too much with the volatility of our portfolio. Basically, the last and one of the important pillars of our strategy is the low barrier to entry. Like I said, our objective with Greenbull is to make it easier for individual investors to get access to investment products, to all the tools they need to take control of their financial future. So for us, it was very important to keep in mind the smaller wallets when creating this portfolio. We wanted a portfolio where you could come in with $500 and get in and be exposed to innovation stocks, real estate, mega caps tech, and crypto at the same time, and diversified, so you manage your risk, but you can still get into the market and get exposed to kind of the high growth innovation that we'll have in the next 10 years. So this was a very important pillar for us, and we really made sure that our portfolio was accessible for smaller wallets. Now that I've spoken about the investment strategy we have, our pillars, I want to go through the portfolio performance. So there are some good years, there's some bad years, of course, so we all know this. So remember, like everybody else, like every fund in the world, the goal of this portfolio is to beat the S&P 500. That's what everybody tries to do. So we're trying to build a portfolio that exposes the investors to the explosive growth of innovation, crypto, etc., while being balanced by dividend stocks and mega cap tech, etc. In 2020, we managed to beat the market, actually. We did almost 21%. Where the S&P 500 is 16%. So this was a very good year for us and for everybody else, I'm sure. In 2021, we also beat the market. We are at 25.73%, where the S&P 500 is at 22%. In 2022, we all expected a lot of volatility this year. We all knew the Fed was going to be very aggressive, the monetary policy will change. The outlook this year is a bit more grim than it was. So our portfolio is down, unfortunately. It's down 17%, 17.5 almost, where the S&P 500 is down almost 15%. So, of course, we need to remember that this is a portfolio that is supposed to beat the market, but it also follows the market. So if the market is going up, we are going up. If the market is going down, unfortunately, we're going down. This is just the way things go, and I'm sure we will recover. There is no worries there. We also have to keep in mind that year to date we're 17% down, right? So if you put 10% of your wealth, of your total wealth, into your portfolio, like, okay, this is my allocation for my stocks. I'm going to buy the Greenbullinvest portfolio 10%. This year you would be down only 1.7% of your total wealth. It's not the end of the world. It's not that big of a deal. As long as you're not too heavily invested in portfolios that are going down because of the macroeconomic outlook, you should be fine. We need to keep a long-term outlook. We need to keep it in mind that this portfolio is for the long term and we're trying to invest in innovation for the future. So now that I went through the performance of the portfolio, I want to talk about the market outlook we have for this year. So it's a bit grim. It's not the best year. We know there is inflation, so we have an inflation of 7 to 8% because of supply concerns, because of all the COVID, but also because there was a lot of money printed in the past 2 years. I think we printed about 30% of all the money in the world in the past 2 years. So this abundance of money created an overheating of the economy, which led to high inflation, unfortunately. So high inflation means the central banks now have to be more aggressive because, well, their mandate is full employment and low inflation. They aim for an inflation at about 2%, and we're at 7 to 8%, which is just not going to work. So this leads to central banks being very aggressive this year, meaning they're increasing their interest rates. They have an aggressive monetary policy. This is just to slow down this overheating economy where there's a lot of inflation. But this also leads to the second market outlook, which is what we observed recently, which is deleveraging. Following the COVID booms, there was a zero interest rate environment. You could borrow money for free, basically, without paying any interest. This created a space where people would borrow money to buy assets. So before the COVID, the assets bought with borrowed money represented $500 billion. Last year, they were at $900 billion, which means that the assets bought with borrowed money doubled because of the low interest rate environment. This year, the Federal Reserve decided to increase the interest rate. So now the free money is not free anymore. So a lot of people had to reevaluate their projects, and a lot of the stocks and the assets that were bought with borrowed money now had to be sold because the money that they borrowed is not free anymore. They have to sell their assets. So that's what we're seeing every time the Federal Reserves announce a rate hike, the money gets less and less free. A lot of the assets have to be sold just because people want to keep less debt on their books. So we already saw that this year we went from a 900 billion assets bought with borrowed money to 700 billion assets bought with borrowed money. So just in the past few months, 200 billion assets that were bought with just borrowed cash had to be sold. And we all know that heavy selling means market goes down, means price go lower. So this is just how it goes. So this year, I think the theme of the year is going to be volatility for all of 2022. I think there's going to be volatility in stocks. We all saw that the prices were going up, they were going down. All the movements were very aggressive. We saw this in crypto too. It was hard to catch a break, to be honest. Everything is going very fast and always in the exaggerated movement. And every time there is an exaggerated movement on the way up or on the way down, we have the dealers on the other side that need to rebalance their books, which means they have to sell and buy more just to balance and protect their positions, which creates this highly volatile environment. We also have volatility in bonds because every time the central bank increases the interest rate, the bond prices, the bond yields need to be readjusted to reflect this new interest rate, which messes with the bond prices, which messes with the mortgages and the real estate industry. I think one of the real estate funds that I follow, which is VNQ, lost 14% this year, and it's real estate. It's a market that's still doing pretty well for 2022. So all of this is happening. Everything is grim, deleveraging, a lot of selling, inflation is going crazy, central banks are aggressive, but there is still expansion. Like whether we like it or not, companies are still making money. The companies are still growing. Some companies lost subscribers like Netflix. Some companies did a little bit less well, like Facebook, but remember, it's just that they're growing less fast. It's not that they're not growing or that they're contracting. It's just the growth is still there. They're still making more money than last year, but it's just less fast than last year, which is what the central banks wanted. They wanted to reduce the overheating of the economy so that we can get control of the prices flying to the sky. So there is still some expansion, and we can observe it sometimes by comparing the dividends from the dividend yield in percentage from a few years ago to today. We can see that, well, the companies are paying higher yields than a few years ago, which means that they're making the same amount of money, but it's just that the stock price is lower. So there is opportunity there. It's just that the heavy selling and the deleveraging of the market is pushing the prices down faster than we can catch the opportunities. We also had, of course, we all know we also had the war in Russia and Ukraine. Nobody expected this to happen, which added a lot more volatility on top of the volatility that we already had. This also contributed also to a lot of loss of revenue for companies that were operating in Russia. We saw a lot of companies that would have beat their earnings, missed their earnings just because of the lost revenues that they had just from shutting down their operations inside of Russia. So this also affected the earnings of the companies, which affected, of course, their future valuation and their stock prices. This also contributed very heavily on the energy price crisis. So we all know that now oil is extremely expensive, which contributes to the inflation, which contributes to the Fed and the central banks being more aggressive. And the more expensive is the borrowed money, the more people have to sell to deleverage their position and to remove the debt from their books. It's all linked together and it creates a little bit of a dark outlook for the economy. But all of this is very grim. There's a lot of things happening, but is there any opportunity at this point? Because, well, the market lost more than 10%, about what, 34 times in the past 20 years, and it always recovered. It always recovered every single time. If we believe the companies are still going to be there, if we believe the banks are still going to be banks in the future, if we believe the government will still govern and the roads will still road in 10 years, well, it means you have a bullish outlook on the market. It means you know that the assets and the real estate and everything will be more valuable and creating more cash in the future. So in this case, the main strategy you can have is you're doing your DCA, doing your dollar cost averaging. If you think in the future things are going to get better, and today, well, there's a lot of deleveraging, there's a lot of heavy selling to remove debt from the books, well, is there an opportunity there? We see that companies are still growing compared to last year, they're making more money, but their stocks are a lot cheaper. So what's going on here? You know, so there might be opportunities to be found in the market stress. When everything is priced perfectly to perfection and volatility is very low, well, it's very hard to catch a good price on an asset. When everybody's panicking and when there is a lot of money moving around and a war and a crisis, etc., that's where you can find good deals too. In 2020, when there was the COVID crisis starting, the prices were free falling. Well, everybody was saying it would be crazy to buy now, but a lot of people that bought at that time, the crazy people that saw the opportunity and they thought, wait a second, this pandemic is not going to last forever. These prices are too low. The companies are still making money. So let me get in. And they actually got good deals on their money. I think a lot of people forget when you do your dollar cost averaging and your DCA on the way up, everybody's very happy. The market is going up. Prices are going up. Everybody's buying and buying and buying and buying and averaging up their price. But as soon as the market goes down and prices go down, people panic and they change their outlook from a long-term to a short-term outlook. They're like, oh, now I'm checking my portfolio. Now I don't know what to do. Now I need to think more about what's going to happen. Well, instead of averaging up when prices are high, you need to also average when the prices are lower because you want to get a better prices. So when markets are down, it's a good time to start buying to get a better price on the companies you believed in, on the crypto you believed in, on all these things you bought because you really believe the economy will be better. You believe that in 5 to 10 years, all these assets, all these companies will be producing more revenues. They'll be more valuable. Well, now when we have market stress, it's a good time to catch the good deals on all the things you believe in. So I think the base of the good strategy to have in this kind of times is to do your dollar cost averaging, to not just average your prices on the way up when it's very expensive, but to also start averaging on the way down and get a better deal on the things you really believe in. So just remember that in the long term, markets always recover, and timing the market today, yesterday, or last month won't really matter in 2 or 3 years. It won't really change anything. It won't really make any difference. So if you want to invest in companies and crypto you really believe in, you have to average down when the market is down as well as when the market is up. And so yeah, that's about the market outlook. So if you have any questions, don't hesitate to post them in the chat. Is this crisis considered a surprise for the market, or could have been expected, and in some way defensive strategies could have been taken before the fall in portfolios? Well, to be honest, we knew there were going to be more volatility. We didn't expect the Fed to be that aggressive. We knew from September, that the Federal Reserve and other central banks will change their interest rate and that the free money will end. We all knew that, but we expected the free money to end very slowly. So we expected the interest rate to raise very little by little. The thing is, inflation went a bit out of control, I think, and with all the war, the energy prices went up, so inflation became even worse. So now we have central banks trying to fight back a bit more aggressive than was expected, which created this environment where all the portfolios are falling and cryptos are falling, and this very heavy deleveraging in a very short time span. We expected the interest rate hikes to be 25 points every few months, but now they were 25, 50, and now they're thinking of doing 75. So we're going at 3 times the rate of aggressiveness that we expected. And so the companies and the funds that had leverage, that borrowed money to buy assets, well, now they have to get rid of these from their books as fast as possible. So we see a lot of volatility, we see a lot of heavy selling. It was not expected to be that intense. So it was priced into the market a while back, but we didn't expect it to be so bad. So now there is a lot of movement that needs to be done very fast. And very fast movement and very fast selling means, well, volatility and a lot of confusion. As I said, we see that the companies are still growing. We can see that they're growing slower, of course, but they're still growing. So compared to last year, they're still making more money, but the price is a lot lower. So we have to maybe find some opportunities there. I agree that a lot of defensive actions could have been taken, but it was hard to expect that there was going to be a war, that inflation will be that much out of control, and that the Federal Reserve would be this aggressive with the traders and the lenders in the market. Do you consider shorting for hedging purposes? Well, for our portfolio, it's a long-term portfolio. So as I said before, we strongly believe that the markets, both the assets, real estate, everything will be more valuable in the future in the long term than it is today. So shorting would go against that idea. You would short for a short-term trading. So for example, we have a lot of people with Greenbull that took a course called Wall Street, which is short-term trading. So there, yeah, we do teach you to follow the market in the short term. So if it starts going down, you catch it when it breaks out on the downside, etc. But in this case, sorry. So yeah, but this is a different kind of case. This is a short-term case. In the long term, assets prices should grow. The economy should grow, the real estate will be more valuable. So in this case, shorting would go against our vision of long-termism, one of the 6 pillars of our portfolio. Guillaume asks, hi, what is the estimated profitability at the end of the year? Thanks. Well, this is hard to say because I'm not, we say in French, Madame Irma. I don't see the future. We don't know how aggressive the Federal Reserve will be. We don't know how much deleveraging will still need to be done. We know that we started at 500 billion of, like I said, assets bought on borrowed money. We're still at 700, so we did half the way down of getting rid of the debt. Now we need to still close the gap. We don't know if the Federal Reserve, if the inflation starts slowing down, the central banks will be more accommodating. If they start being more accommodating, then the selling we can take longer, so it will be slower. So it will like dampen the volatility. But hopefully, the markets will recover this year. Do you plan a different balance in your portfolio to again beat the S&P 500 index through its negative side this year? Very good question. So far, we're not planning to rebalance because it would be a bad time. You don't want to be one of those people that sell in the panic. You don't want to sell in the panic. You don't want to sell when it's the worst time to sell. I think the rebalancing will be done at the end of the year. We'll kind of reevaluate if the innovation and the companies we invested in are still up to date, or still we still are bullish on these companies. We still think they're going to grow and they're going to be the future and they're going to be massive in the future. So if we think that these companies will stay great innovations in the future, then we'll keep them. If we think that some of these companies maybe are not that good anymore, and well, this year they didn't prove themselves enough, then we will reevaluate. We might include new companies that are interesting innovation in the portfolio. The goal here is really to expose ourselves to the innovations of the future, and at the same time to balance it with all the dividend stocks, etc. So innovation is not happening very fast, but also we can have an idea. So I think the rebalancing will be happening at the end of the year. How can I actually DCA with amounts below $200? If I remember well, it's not possible to copy up and trade. Yes, I believe it's $200 minimum. for your DCA. So you need to have 200 at least to get in. I think this is just a limit. We try to make it as low as possible because we really created this portfolio for people who want to invest a little bit of money, who maybe don't have thousands and thousands of dollars to put in with a bank, which has very high fees, or with a broker, which requires like very high requirements. But unfortunately, it's a $200 minimum. What I suggest, what I try to do every month is when I get my salary, I take out $200 and do my DCA with it. Or I wait if I see that the market is a bit too green, then I will wait for a red day, to get a discount on that day and just do my DCA at that moment. Alors, Kevin, will we be able to reinvest in Russian companies such as Gazprom? Lukoil, for example, I'm asking because I'm very Russian stock was currently frozen on eToro. Yeah, I know. Because of the sanctions with Russia, a lot of the Russian stocks are currently completely blocked. It's not just eToro. Other brokers have the same issues. With my bank, it's the same issues. So unfortunately, it's not going to be possible for a while. When the situation with Russia eases up, the sanction will ease up very quickly, and then we'll be able to reinvest in the Russian companies again. And there might be a lot of opportunities there because then all of the funds that held Russian stocks had to sell. So all the Russian companies are at a discount right now. So when everything eases up and the war is over, hopefully soon, very soon, we will be able to reinvest in the Russian company and catch these opportunities very quickly, hopefully. Karim. Bonjour, Karim. Let's say, oh, by the way, if you have questions in French, I speak French too. So you can write them in French, it's no problem. Let's say I put an amount in the portfolio, but without copying open trades, that to avoid selling positions that just have been open, happens to be November, September, and so my question would be, to putting money in the Greenbullinvest wallet and wait that you guys open trade at the best time is okay. Yeah, sure. This is a long-term portfolio. It's we picked companies we believe in the future. We picked some mega cap tech that are very stable and that are like kind of like the big guys we can rely on. And we have the dividend stock, some real estate that pays you every month. So it's a portfolio we're not planning. It's not a very active portfolio. It's a portfolio that we think, okay, this is the composition of innovation and companies and dividend aristocrats that will be more valuable in the future while still giving us a regular income. We have, I think, approximately a 3% dividend rate on all the stocks. It's an approximation, of course. So the goal here is we don't really change it a lot every time there's something happening. It's just a long-term outlook. So it's absolutely fine to put money in the wallet and just to wait. And to do the open trades later if you want to. AD, how long do you plan to keep positions open on average? Bravo l'équipe. Thank you, AD. I think we rebalance about every 6 months to every year. We really want to have a long-term outlook. We want to keep the companies there for a while. It's really companies we believe in. It's the innovation of the future. Like I said before, we know that companies will be more profitable. The innovation will be crazier in a couple of years. We know that the markets go up. Now is a period of stress, and I understand a lot of people might be scared. But we have to keep in mind that the economy will grow in the future. And we believe that these are the companies that will be in the center of this growth economy. We usually will check it out again every 6 months, every year. If some companies are starting to show that they're not, maybe they won't be in the center of the future innovation we're aiming at, then they will be removed and we might put other companies there. But we plan on keeping position open for like a year or more. Some companies that we know are going to be good for 5-10 years, we're going to keep them for a very long time. Other very innovative companies, we'll have to reassess every 6 months to see that the company is still good, to keep them in the portfolio or not. You mentioned crypto in your presentation, but what is the view about long-term investment in crypto portfolio, mainly altcoins? Well, it's a risky asset. Like I said, we don't know where they are legally. It's changing a lot. There's a lot of new regulations, but we all know it's the future. We all know the technology is groundbreaking. We all know the return on investment is huge. But what you can make on the way up, you can also make on the way down. So usually on crypto, you want to put a smaller allocation. In our portfolio, crypto has the smallest allocations per coin compared to stocks, which have like larger allocations. This is because the swings in prices can really mess up with your portfolio allocation. It can really make you stress a little bit. But if you're looking at a very long-term outlook, I think investing in crypto is good. It's one of the main innovations we have of our time. There was AI, there was the internet, and now there is crypto. Don't go all in, don't be fat-fingered. Put a small allocation of your capital into crypto. If you see some altcoins where you like their projects and you think, well, this project might be useful for the faster transactions, cheaper transactions, moving money around, etc., then go for it. I mean, that's what it's for. If you believe in a project, you go for it. Just don't get too fat finger. Don't put too much money. If you put 5% of your wealth in crypto, if you lose half, it's just 2.5% of your wealth. You're going to be fine. So it's just about being smart, doing your money management in a smart way. And then I'm sure the project will be, you can invest in the projects you want and it will go very well, I'm sure. Do I believe that the Luna event might affect other crypto investment? I think it might shake the faith that some people have in crypto. What happened with Luna was just that the algorithm that managed the stablecoin kind of like broke itself because there was too much selling, too much deleveraging, like I was saying earlier. So if you bought a lot of crypto with borrowed money and you're an institution, well, you need to sell it. And the algorithm was not made for such heavy selling at one time. So it kind of like feedback looped on itself and it broke. So a lot of people are saying that these algorithms for stable coins need to be refined, or that they don't work because they're too easy to break down. So I think it will affect the technology, just like every project. You know, when they started the internet, when they started AI, a lot of projects would start and one would break, and it would teach the other projects how to get better. So I think this event will teach the other cryptos and the other stable coins how to improve their models, how to make sure that these things don't happen. Like, you know, we all learn from our mistakes, right? So I think it will affect, but not in the way where like the other cryptos will all crash, but in a way where maybe the investors will be more careful. They'll be more careful with the projects they're investing because they will be scared these kind of things happen. And from the project side, I think they'll make sure that the algorithms are more fine-tuned so that they can handle these kind of events and that these things don't happen anymore. That's what I think personally. And I think they're launching a Luna 2, right? So I think they're gonna launch another project. So maybe they'll be able to fix the mistakes they did in the algorithm, and this time it will be a great crypto project, hopefully. Thank you so much, Zara. Thank you everyone for joining, and great questions, everyone. You did great. Bravo l'équipe. And see you for Q3 for more adventures. Huh? Bye-bye, guys.